What's your outlook?
So ultimately what we have is all the Fed speak that's going on. And unfortunately what we're finding is that the market remains more data dependent than the Federal Reserve at this point in time, reacting to individual discrete points of inflation and clearly growth in unemployment. Ultimately, that's going to be reconciled. But when we look at the survey, the landscape, Fed officials are going to be thinking about what's the proper unemployment rate that they are comfortable with. Is that necessarily a linear trajectory? It probably isn't. And over that point in time, ultimately, what is the neutral rate that you have to get to, which facilitates a balanced economy? Now, there's a lot of conflict in that right now. The Federal Reserve thinks that's somewhere between 3 and 3.5%, something in line with what Pimco believes, but yet the market suggests it's somewhere around 2.75%. So that neutral rate actually is very divergent from that, and almost suggesting that the economy, or that the market right now, is looking at a recessionary or hard landing for the economy. That's the construct of what we're dealing with right now. So market is interpreting, risk assets are interpreting that the put, if you will, risk assets are going to be supported in the near term and longer term by the Federal Reserve, when in actuality, that road may not necessarily be as smooth as participants might encounter.
So how do you think we'll resolve our differences?
So ultimately, you're going to resolve your differences by rationalizing where growth is, how the economy develops. Admittedly, consumerism is very strong right now. You're going to see a third quarter consumer print about 3.5%, third quarter GDP, that's very sustainable at this point in time. And even PCEs over the next day or so when they're released are going to be slightly stronger than expected. That doesn't necessarily mean the economy is rolling over in the near term and may not necessarily elicit the function from the Federal Reserve that people think in the near term. Now, that doesn't mean you don't get to R star. You eventually will, and so there are rate cuts. And so we have to be careful as practitioners at Pimco, but also as individual investors, to think about how that evolves. And that doesn't mean that you should be reacting to every single maneuvering in the front end of the market. And then to your note, we're not all Fed funds traders. We shouldn't be. We should look instead at the potential for price appreciation that is derived from Fed yields moving lower and prices moving higher. That's what's interesting out there right now at this point in time.